In the light of the recent crashes in the market, here is a short demonstration of how to go about trading to make the most of this turbulence. I have used my Zerodha account for the same, which I believe is far more user friendly than any other platforms that I've used so far. To begin with, you need to have a basic idea of what options are, how they operate, and there is a lot of information available online to help you with it. I will try to take you along the process using as little terminologies as possible since it's very easy to get confused. I would, however, like to make it very clear that options trading is not something for the faint-hearted. Also, if you're a student or at the moment if you're struggling with your income, I recommend that you start with paper trading so that you get some confidence before actually getting into the market. Now, paper trading is a scenario where you take virtual positions, you note them down, and then you try to assess how your performance would have been had you actually invested in the market. This is for you to get a clearer idea of whether you have got a grasp of the movement or not. Now, the first question is, what is options trading? Now, options trading is much like gambling and betting, but here you're actually making informed choices based on how the financial world around you seems to be behaving. In essence, you're making a prediction about which direction it is going to be heading towards. How is it done? We use indexes like Nifty and Sensex to understand the health of a financial system at any given scenario. It is an amalgamation of different industries, telecom, healthcare, infrastructure, services, and so forth, and hence an average gives you the idea of how the businesses are performing in general. There are specific clusters, also called indexes, from different sectors as well, but we can skip that at the moment because now Bank Nifty, Media Nifty, these are very complicated topics where they required a very focused approach, so we can leave that out for now. In the video, we'll just be using Nifty 50 as our prime index, and it will be referred to as the market throughout the video. Now, coming to the part of discussing what exactly an option is. Options, also known as derivatives, are used to invest on the movement of the market and not an actual stock. So there are two kinds of movements that can happen. The market can either go up or down, and similarly, we have two kinds of options, which are call and put. If you feel that the market is going to be heading upwards, you would either buy a call or sell a put, or if you feel the market will come down, you buy a put or sell a call. The value of an option depends on two things: the difference from the points that you have chosen to take the option for against the actual market position, as well as the time left at the end of the month to that point. Today is the 6th of March, and there are a lot of trading days left in the month, which means there is plenty of time for the market to make a move in any direction, which means at this point the time value for both the options, the call and the put, is pretty high. To start with, as you can clearly see, when I shot the video, the previous closing of the market was at 11269. And before the market closed yesterday, there were strong vibes that the market will go down the next day. And I consolidated all my positions and left one put position unsold to make use of that early movement that came in tomorrow, hopefully. On the screen, you can see that the present position shows that I bought a put of March 10800, which means I am expecting the market for this month to close below 10,800. And at the moment, the market is 469 points away from the position that I've suggested. As we get closer to the 10,800 mark, the value of this option will keep increasing, since the chances of the market closing below this point will keep getting higher, and the contrary is also true. The further the market goes away from 10,800, the lesser will be the value for my option. However, this is not the only way of earning money on options if you can spare enough time. You don't have to have your option positions ready the day before. You can actually make use of any movements on that day as well. So here is how to add a particular option. Now I'm adding put 10,200 March, which means I'm expecting the market to end below 10,200 at the end of March. So I'm adding it to my watch list so that I can keep an eye on it and buy and sell it according to the movements. So it's around 9:07 now that the initial movements of the market settle down and the market opens for actual trading at 9:15. During this time, you can keep an eye on the global markets because keeping a tab on the major indices across the globe really helps you understand where the market sentiment might be heading this day. Right now, I'm using Money Control's website to do the same. As we saw earlier, when the market was just 11269, the value of my option was at 106. But when the market opens for trading today, it has already fallen by more than 300 points, which means the chances of this month ending below 10,800 are pretty high. And hence, the value of my option has now shot up from 106 to 250, which means by the time the bell rings today, I would have earned around 10,800 rupees already. Here is how you place an order to sell an option. You type in the name, it's Nifty, whichever point that you want to head to, that number and the month. And then you select the option, mention the number of lots, the lot size is 75, and then you add the price at which you want to buy or sell. As you can see from the list, I've been buying and selling options multiple times to make use of the small variations. You buy something at 100, you sell it at 105, then you again buy it back at 99. You do this multiple times and you make enough money out of this if the lot size is high. There is no limit to how many times you can do this, and these high frequency trades are usually very useful when the market has started being stationary to one particular range. So now that you have almost a clear idea of what options are and how they are to be traded, at least on the Zerodha platform, there are a few things that you need to keep in mind. Firstly, these movements can be very rapid, and hence investing a lot of money when you don't have a lot of disposable income is not a very wise move. It is important that you start slow and invest little, and also not be greedy for a large sum of money in one go. Try to consolidate your positions, use the money that you have made out of profits to make those riskier bargains, because eventually if you end up losing a lot of money, you will end up making a lot of bad decisions under the pressure of losing further money, and it's a vicious cycle and it is very easy to get caught up. You cannot win every day. That is something that you have to accept. I mean, in the market, you make money only when someone is losing it. So some days you have to give it back as well. So keeping that in mind, start with paper trading. Drop in any question that you may have, and good luck with your trading. Have a great day.